Hi, and welcome to this week's Stockscore's Market Minutes for June 28th, 2013. This week's topic, breaks of upward trend lines. A strong move down through an upward trend line is a sign of weakness. Now, this could be a trend reversal signal or simply a pause in the upward trend. We have to be cautious after upward trend line breaks because we don't want to get caught in a major correction. And so in the initial days after a trend line break, we want to be pretty careful about what we do. But as time passes, we start to get a sense of whether it is simply the start of that pausing formation or if it is something bigger. Now, trend line breaks from falling tops are more worrisome, but once that has occurred, what we want to watch for is whether the next break down or up is from a falling top or rising bottom. If there is a rising bottom building on the chart, then we're probably entering one of those sideways trading range type actions. If instead we break down from another falling top, well, then that is more worrisome. So here's a chart of the S&P 500 ETF, SPY. You can see the trend line break a little over a week and a half ago, and that came from a falling top. So all the signs are there that at least the upward trend is ending for the short term. The question now is whether the market can rally back up to that 166 level, in which case it would have formed a new high from the last high, or if we break down again from a falling top. Now, if we were to pull back in the short term and then build a rising bottom, then we're probably entering that sideways trading range. It's too early to tell on the S&P 500. The bounce back has been pretty solid so far, so it's starting to look like we're probably entering into one of those sideways trading range type things. But if in the next few days we broke down from a new falling top, one that is lower than the 166 high that was set in the middle of June, well, then you probably want to run for cover. All right, here's the long-term chart of the S&P 500, and you can see that in the 3-year time frame we remain in an upward trend. And really what has happened is the market ran away from that trend line, went parabolic. That is a sign that the buyers were emotional, sending prices higher in an irrational way. And what we're going through now is simply taking out that irrational behavior in the market. The market is likely to get back to that upward trend line. Now, it could do that in 1 week simply by falling very quickly down to the 151, 152 level on the SPY, or it could go sideways for a couple of months, and eventually by going sideways it runs into the upward trend line, which of course is rising over time. My feeling is we're probably more likely to spend the summer going sideways, getting back to that upward trend line, rather than a sharp correction, but it's still too early to call this one, and so we need to be somewhat cautious with the S&P 500. Here's a chart of the TSX market. You can see that for the last 4 or 5 weeks we've had a pretty significant pullback down to support where we bounced last week, and I expect that we will now stabilize and move higher in the short term on the TSX. However, the long-term pattern here is one of basically sideways trading. We've been in this sideways range for almost 2 years now, and that's really why the Canadian market has been so boring to trade. There's just not a lot of action in the Canadian market. It's not exceptionally bad, but it's not exceptionally good either. The TLT, which is the Treasuries, had an emotional sell-off over the last month and a half, and it looks like we're a little bit oversold there and probably due for a bounce back on the Treasuries. That means interest rates go down. That'll be a bit of a relief for the economy and give some confidence back where we maybe had a little bit of a shake of that confidence in recent weeks. So look for Treasuries to come back, but we can't ignore the fact that we are in a downward sloping trend right now, and so any strength in Treasuries probably will be fairly short-lived. The emerging markets also had a really sharp sell-off over the last month and a half, down to support where we bounced last week. Because the market is oversold on the emerging market side, we'll probably see a little bit of a bounce back in the short term, but some damage has been done here, and expect the summer and into the fall to be sideways, maybe slightly up, maybe slightly down, but certainly not a strong emerging markets index. The US dollar is stabilizing after its significant sell-off through 2010, 2011. It's been mostly going sideways ever since, building rising bottoms slowly, and so the market is slowly starting to find favor in the US dollar again. It could probably go up a little bit higher here before it hits resistance at the red line on that chart, but I don't see a strong rally out of the US dollar just yet. Now, gold has had a extremely sharp sell-off, and we all have probably heard about that already. Oversold at this point. You can see that the trend to the downside has gone parabolic, and we're probably overdue for a bounce. But I think that the general psychology around gold has been broken, where we had all this optimism for a number of years. That has been broken, and probably broken for a long time. And I don't expect to see that real long-term strength come back in the gold sector anytime soon. That doesn't mean we can't get a bounce in the short term and traders could trade that bounce, but I think that the days of the bull market in gold are behind us. Oil market sideways trading range has been strong the last couple of weeks, coming into resistance here on the oil chart. That is at $23 on the ETF, $23.50 or so. And we're going to stall there likely. So don't see considerable upside for oil, but it remains stable, and that is a good thing if you are in the global economy. The VXX, the fear index, had been showing some rising bottoms over the last number of weeks, but I think that that is been broken as of today. That cycle of rising bottoms has been broken, and therefore I think that once again fear is not a factor in the market. Market is starting to stabilize. This could change very quickly, but it's one of those factors that makes me think we are destined for a sideways trading range through the summer on the US stock market. So I'm now raising my rating from bearish to neutral on US stocks, neutral on Canadian. Gold, I remain bearish, but as I said, a bounce is probably going to happen in the near term here. Oil neutral, could see a little bit more upside before it hits resistance. The pullback may be the start of a period of sideways trading through the summer rather than a sharper correction. Gold is heavily oversold and should bounce back, but don't expect an upward trend to develop. Oil is improving but remains below long-term resistance. Earnings season, which starts next week, should improve trading action. Well, that has been the Stockscore's Market Minutes for June 28th, 2013. Have a great week in the market and trade well.